Recently, one of the company registration data vendor in China, Qichacha, has announced that they got approval to transmit data across border. This is in line with our expectation. Half year ago, China has set up this process for company to apply to transmit their data across border. While that episode was interpreted by many foreign media as China creating a new information black box, we think that it was just a new process to build an economy and market around data as a production factor. Time and time again, we keep mentioning that the core principle for China's policy is to build a market and economy around data as a production factor. That's a initiative started in 2019. It takes time for all these policies to mature. It's a big system. There's a lot of stakeholders within the system. There might be glitches during the processes, but it shouldn't be understood the hidden agenda for China to hide data from global user or from the world. So it has always been our view, and Qichacha's news that's prove our view.
To review our basic logics when we explained this a few months ago, it just doesn't make sense for China to so-called log the information into some kind of black box. We live in a information age. There's no such thing that you can really log so much information from outside view while you are also engaged in international trade and investment. It simply doesn't make sense. Although it fits some people's stereotypes about China being a closed system where there's just big control on everything. So at the time, there was a very strong narrative in Western media portraying China into this type of place. That's one thing. Another thing is we should not confuse bureaucratic inefficiency and inertia with any conspiracy or any well-concerted effort to crack down on data or information. China's data regulatory regime is very young. It just started from almost nothing about 3 or 4 years ago, ranging from personal data to what they call important data. And all these laws and regulations are very young. I still remember 5 or 6 years ago, people like to joke that there was no privacy in China. All of the data is sold out, and that created a lot of problems. But only in a matter of few years, people now today are very sensitive about data. A lot of companies won't work on data related stuff, even though there is better rules. But people are actually oversensitive now about data regulation. So that takes just a matter of few years for China to develop from zero regulation to there is regulation. When a new entirely piece of a new regulation framework comes online, it will take time to figure out all the details, all the implementations. So that takes a process. We wish the process can take place instantly. We always wish this can be faster, but bureaucracy has their own pace. We would just take this example as a classic case study that when you look at China, maybe try a little bit harder to be more patient and don't easily jump onto some kind of ideological explanation for everything you see. To me, this is a very illuminating case.
To add on that, just now I mentioned about the many forces in play trying to have a say in the data production factor markets. I'd like to give our audience a more vivid example, right? If someone is applying for a data permission or transmission about banking data, the department that are involved to make the decision would be the local government, the CAC, but not just that, there will be also Ministry of Technology, as well as the central bank and the new data bureau, right? Like Robert said, it's more about bureaucracies coordinating, making sure who is in charge of which part of the approval, rather than bureaucracy or the apparatus not wanting to implement the process. Central bank want to have a say, CAC want to have a say, data bureau have a say. So as an applicant, they have to go to all these ministries and go to all these windows to apply, to submit their application. It's actually not unique to China. If you do that in the US, in different countries, in UK, in Europe, you also have to go through different departments' approval process. So there's a difference between a hidden agenda and or ideological agenda and the bureaucracy process. Anyhow, this is good news. It's a positive indication for China's data market and for folks that want to get more data on China. We can see that there's a step forward on this aspect or on this issue. And in terms of expectation, we know that many companies or many data owners are also looking into transmitting the data overseas. At the national level, China itself is also looking into framework of cross-border data transmission. During the Belt and Road Initiative, we saw that many framework agreements is signed, and within those framework agreements, data has been mentioned. For example, cross-border e-commerce collaboration for Belt and Road Initiative, right? Within that framework, data is a must, and we saw that the update rules for overseas data transmission also exempted part of the data transmission that's in e-commerce industry, so they don't have to go through the application process. We're expecting the regulation to mature, but it's not going to be a linear maturation process. It'll be 2 steps forward, 1 step backward. So that's on the data. And in terms of changing gear, we are seeing that there are more and more outdated rhetorics about investing in China. My feeling is that a new consensus is being formed on, one, if China is investable. That's turning from a negative answer to a positive answer. 2, if China is investable, how to invest in China? What kind of assets are investable in China? And 3, is it secure to invest in China? So more and more, we're seeing different cases across the board about understanding the current situation in China, including the real estate situation, the macroeconomic situation, and the new also are more reflective of the actual economic structure in China. Our fellow writers, Zhang Jiang from Ginger River, recently published an article from Shan Weijian, the founder of PAG. Robert, you have dived deep into the report. Can you talk more about that?
Yeah, it's a very interesting report. It's, as you said, kind of a new rhetoric is being formed. And in this sense, a lot of the big shots are coming onto the stage and be quite vocal about their opinions. So Mr. Shan Weijian of PAG is a very good case in point. A little bit background about PAG is, I would say it's one of the largest private equity funds in Greater China region. And Mr. Shan himself has been, over the last couple of decades, have been involved in some of the most landmark deals in China. That included, when he was at TPG, the merger and acquisition of Shenzhen Development Bank. And at PAG, he did a lot of very big deals, including some of the largest ever private equity buyout deals in the history of China. When he's starting to publicly voice his opinions, people should listen. So I did read his report and I find it quite informative. He actually took on this question whether China is investable, is Chinese economy doomed, what are the new opportunities, all these very big questions head on. So he is pretty explicit and frank about China's current problems. And I think to him, a big problem is this real estate malaise, right? Basically, over the last 2 decades or so, the biggest pillar of China's growth is real estate industry, and that industry is kind of falling off the cliff right now. And so he takes that as an assumption and look at, what exactly kind of impact will it have on China. And his conclusion is, although this is bad, it's not lethal for the Chinese system. There are several interesting angles he takes. One big kind of consequence of this real estate thing going down is the drag on local government finances. So a lot of people are concerned about the public debt situation in China. So he did a very concise but also systematic review of both the Chinese government's debts and also the banking system. For example, he looked at the total debt in China. For the central government, it's actually a pretty low debt ratio. The main problem is in the local governments. But even you take all those debt together, compare with Western countries like US and Japan is actually not such a big, it's even lower than some of those countries. And also, an interesting point he makes is, Chinese government is also different from other government in the way that they control a lot of assets. So the asset quality, including the state-owned enterprises, the land resources, all of these asset qualities make the net asset of the country, of the government, to be of pretty high quality. So that ensures that the current, I would say, crisis is not going to balloon into a Western sense of, financial crisis. He draws that line pretty eloquently, that there's a limited systematic risk. And then he goes on to explore what exactly will be the pillar. He is very detailed and also and very optimistic about the technological growth in China. In this case, he quoted the KKR Asia report, which we also shared last time at podcast, which also quoted data from us. Mr. Shan, he quoted KKR's report specifically about the sections about the new economy, the green economy, the high-tech economy in China, and the growth of the manufacturing value added. All that was going to be a new pillar for China. I think he's very explicit about that. We also agree with him. We also want to point out that technological progress, this climbing up the value chain, is not going to be successful instantly. It takes time to build. It's actually harder than building out buildings and towns. Technology takes time, takes the talents, takes accumulation of both know-how and capital, and also a good market for the technology. So it's going to be a process, and that process will bear fruit. It's, again, come back to the patience, right? Be patient for the economy, and I think it just will take some time, but it will, we will see the fruits one day.
Yeah, we can expand more on that to do some comparative study, right? You mentioned about the first part is he's mentioned about China's real estate bubble being bursted. We want to remind our audience that unlike how real estate bubble burst in other countries, China actually actively tried to cool down the real estate markets initially a couple of years ago, right? So and at the government level is that we want to cool down the real estate industry. From this perspective, they are very transparent about it. That's the difference. Meanwhile, if we look at the balance sheet, like Shan mentioned in his report, and like Robert mentioned, the balance sheet overall, national balance sheet of China is healthy. Every time there's talk about big debt crisis or China's debt level, I always compare it against the total savings of the Chinese economy. Right? There's over 200 trillion RMB savings in the Chinese economy. That's an aggregation of private individual saving plus company saving, retail consumers saving. There's over 100 trillion RMB. So we need to put different debt issues and different numbers in perspective by looking at this broader number, and that's what Shang did, and that would be helpful for many of our audience who are looking into macro of China. And so the key here is actually more sentimental, right? People are saving more, that they're not spending as much. So the government's job is really to strategically mobilize this capital, this wealth, to address different problems. And that's why we are seeing this special sovereign bond we mentioned in last episode as a tool for the government to hopefully borrow from the savers and then transfer those savings into directing this saving into spending or investment that would revitalize the economy. So that big background would actually put things in perspective. I think it's easier for analysts to draw metaphor or draw comparison between China's current situation and similar situation happened previously in other countries. So initially there's talk about a real estate bubble turning into a Lehman-like episodes, right? A few weeks ago, there's talk about Lehman moments, right, for China.
I don't think there's a Lehman moment. The system just just wired totally differently, the US system, the Chinese system.
So they talk about living moment, but if you look at the deeper, like you said, the system, the fundamental of these episodes, it's going to be different. The government itself is managing, whether good or bad, the unfold of this moment or this episode about real estate's bubble burst. And then there's talk about balance sheet crisis, another metaphor people trying to draw between China and Japan in the 90s. But then if you look at the overall balance sheet, it's actually also different. There's no external force that is forcing China to up their currency valuation and restraining China's policy and room for maneuvers, unlike what Japan experienced in the 90s. So that's the context. One key point that we need to bear in mind is that China has all this historical lesson to draw from. They saw how 0809 unfolded, right? They saw how Japan dealt with the balance sheet crisis, dealt with the population crisis, right? So as a followers, they actually have the lesson to draw from, and they are trying to do things that differently, right, from those lessons. There are scholars that study all these episodes that unfolded in other countries previously, and they are trying to get the lesson learned. So keep in mind, all these episodes that China is experiencing has happened in other countries. And from our point of view, given that Chinese government has this pragmatic philosophy when setting their policy, they will take into consideration of the historical lesson. Besides Shan, we also saw similar rhetorics among other investors in the underreported events that I recently saw at the Middle East. Nielsen, right, the head of Hongshan Sequoia China, was in a roundtable with the head of other big global financial institutions like Blackstone, BlackRock, Goldman Sachs, and Morgan Stanley, talking about China. His narrative is that you got to take a long-term view about China. There's cycles, and then this is first down cycle that's experienced in China. And in the long run, China will work out all these downturn cycles problem. Around the same time, at Bloomberg's New Economy Forums in Singapore, the head of Ping An Insurance, as well as the head of a large private equity, Primavera, in China, also talk about China at the forums. And Robert told me that the report about Fred Hu sharing is actually more negative. What was that rhetoric in some of the media's reporting?
I think a lot of people just seize on his line that he think the entrepreneur's confidence has been the lowest he saw since 1978, which is like the beginning of reform and opening and the end of Cultural Revolution. So that line is quite startling. But I think he actually put that into a bigger context, which he is advocating for more deeper and structural economic reforms to make businesses to be more confident. I think overall what he's arguing for is a reform agenda, not really just trying to sound a pessimistic view. When he shared in that conference, it's similar with how Mr. Shan Weijian of PAG came out to voice their opinions. It just seems now the big titans of finance feel it's the time now for them to have their say as well, to make their voice heard. And I think they will not do it unless they feel that right now the general atmosphere is also shifting towards more reforms, more growth, more confidence. From our perspective, we like to put that into that kind of context instead of just taking a line and say, oh, China is going all downhill. I think that's a very different angle.
Yeah, I think this is a good signal, right? Not that all these investors are planning to put out the same rhetoric at the same time. There's no such circle or community that they're exchanging views together. But if we look at that, Shan Weijian published an article. Neo Shen recently went to Saudi Arabia to talk about that. There's this head of Ping An Insurance, one of the largest insurers as well as asset allocators in China, which is a state-owned company, and Primavera, another leading is in China, and us, right? I went to China Project's seminar recently with Liao Ming, which is the head of PAC, another growth capital investors in China, who is very vocal. They are all sharing this view about investing in China. There's a saying in China called 春江水暖鸭先知. When spring comes, the water gets warm. The duck will feel it first. In our view, the capitalists or the investor, we shouldn't use the capitalist term. The investors are the ones that are seeking profit, seeking new opportunities. The fact that there's a group of them going there to speak out about investing in China is a signal that we can chew on. And another anecdotal note I'd like to mention is that recently in Shanghai, I also saw that during the annual general meeting of a couple of leading venture capital in China, we saw foreign LP, foreign limited partner, conventional big allocators in Europe, in the US, now are coming back to China, first time in 3 years or 4 years, to meet with their general partner, which are the VCs and PEs in China, right? But when I talk to them, they are still refreshing and updating their views on China. So I think there will be a process for that. They are the early adopters, like KKR, like Shan Weijian, who spend more times and resources on the ground, who have early updates of their investment framework on China. And then slowly we're seeing that the mainstream investors are also adopting and appreciating the new framework. But one reality that's also part of consensus is that it's not easy to invest in China. It wasn't easy before, it wasn't easy now because it's different culture, it's different system. If we think about the tech investment and the consumer investment, the beginning of the tech investment in China in the early 2000s, it was hard for a VC to invest or find investable targets in China. Just for context, Tencent's founder, Tony Ma, almost sold his company earlier in his venture, right? Because he couldn't find funding. So if we put that context into now, for the new industries, the new economies, new manufacturers, upgrades, new energy sectors in China, we should expect similar cycles happening where global investors trying to find their way, trying to find their footholds and find their positions in China, the founders trying to connect with the investors and build up a market. So this should be expected for the new industries. That's one point. The other thing is that because I was in the US during the 09, 08, and 2010 Great Recessions, we also had that feelings in the US, right? Back then, if real estate falls down, what would be the next pillar economy? There's a tendency for people to find a simple answer for their framework because it's easier to have a simplistic framework for their decision making. But in the US, after the financial crisis, there wasn't clear pillar for the US economy, right? There's no one single answer for that. But US also come out from that crisis after a couple of years because it has a resilient economy. And China too has a resilient economy. There's all this basic economics activity that's being conducted. The foundation are still there that will continue to grow. Meanwhile, different from the US back then, China has a few potential new pillars that within our visibility, which is the new energy sector, the Belt and Road Initiative, where China can have their manufacture capability exported, right, to other countries. So in comparison, the context and situation China is sitting in now is not as bad as 08, 09 in the US.
Right.